People don't realize this, but when you put money in a Roth, think of it almost like a savings account. I can remove that money any point in time, tax-free, penalty-free, no questions asked.
Are you tired of the roller coaster of the stock market? The S&P 500 just had its worst start to a year in over 50 years. The NASDAQ is down 25%. The Dow is in correction territory, and past stock darlings like Netflix are down over 60% year to date. Why not invest in assets that provide constant cash flow and growth unrelated to the stock market? From private businesses to cryptocurrency, the options are nearly endless. I myself have invested in promissory notes, self-storage syndications, a Bitcoin mining fund, and even a teak parcel down in Nicaragua in my retirement accounts. IRAs, solo 401ks, even HSAs don't have to be constrained by traditional stocks, bonds, and mutual funds. And that is why I trust Amanda Holbrook and the Specialized Trust team with my retirement accounts. Reach out to Amanda today, 505-514-0587, or go to specializedtrustcompany.com for a free consultation today.
Are you tired of the 9-to-5 lifestyle? Do you want more freedom to do what you want, when you want it, without sacrificing your current income? Then this is the show for you. Every week, we dive into John's journey towards financial freedom and everything he has learned since 2014. Real estate investing, cryptocurrency, stocks, private lending, foreign residency, tax saving strategies, infinite banking, assets protection, and much more. Now, here is your host, the founder of the Wealth and Freedom Nexus, John Rickgarn.
Hey, Derek, welcome back to the show. Thanks for coming on.
Yeah, thanks, John. I'm excited to be here.
Yeah, so we had a lot of great feedback from your previous time here on the podcast, where we kind of discussed a little more about self-directing, IRAs, 401ks, moving it from the term faulty five of large cap, small cap, international bond and money market fund that most employer plans have, to self-directing. I can buy real estate, a syndication, cattle, a teak farm, Bitcoin mining fund. I've heard all sorts of things that people have now in their self-directed accounts. But yeah, so like we had discussed, I kind of wanted to maybe break through some of the myths out there, because I know a lot of people kind of poo-poo retirement accounts, like, oh, well, it's in jail, it's held hostage, there's no way you can get the money out, you're subjective to regulations and fees and taxes, and want to kind of dispel some of those myths and just kind of get some more ideas to my listeners out there. Obviously we want to keep money in a retirement account, have a good nest egg maybe to pass down, but at the end of the day, life happens. Sometimes you just need the money, and that's where it's at.
Absolutely, right?
Yeah. So with that, and for the purpose of this episode, I just want to concentrate on IRAs and 401ks, as most people know those. Obviously, it's tax deferred accounts. For simplicity, not jumping down the rabbit hole of SEP IRAs, simple IRAs, 457s, 529s,
I got you.
all that stuff. Yeah. So maybe just a high level, John Q, taxpayer, for whatever reason, maybe we can go into some specifics, but they need to take money out of their IRA. They need to take money out of their 401k. What are some options that are available that, John Q taxpayer has available to them?
Sure. So the first thing you always want to consider, okay, is when you're talking to someone on the phone at Fidelity, Charles Schwab, Vanguard, insert whoever your banking institution is, your retirement company, most likely they're not an expert when it comes to retirement accounts. Even though you might go to retirement like, oh yeah, I have questions about this, they're not going to be an expert in the field. Okay. And what you say to them is very, very important. Okay. Prime example, if you say, I want to pull money out, if I want to take a distribution, or if I want to do a rollover, all three of these things are considered different categories. So in this, if you're someone today and you go, you know what? Life happens, like you said, and I need access to my retirement account money now. What you want to do is first say, hey, I would like to take a distribution of X amount of capital, and already kind of have that type of money lined up.
Okay.
Using this terminology, what will happen is the person on the phone is immediately, because they have a book in front of them.
Okay.
And they're going to say, hey, they said distribution. I turn to the distribution page. Let's walk through those motions.
Okay.
So that's step one. It's just getting the right verbiage in place.
Got it.
After that, they might have a series of questions. Well, why do you need the distribution? What's it for? And some of these you will probably have questions. Is it going to be taxable?
Mm-hmm.
Is it not going to be taxable? Is it penalized? So I think we have to break down each one of these categories and figure out whether taxation applies, whether it doesn't, whether penalties apply, and what is the money being used for.
Okay.
So I think I can just break down, some pretty standard or basic examples if you'd like.
Sure. Yeah. Go ahead.
Yeah. So the first thing is I always like to talk about the type of account.
Okay.
If you have a tax deferred, a traditional IRA, or typical 401k, something like that, these are tax deferred.
Mm-hmm.
I'm deferring taxes to a certain age. So anytime you take a distribution, automatically you're going to owe taxes on this money. I don't care what it's for. All right. However, do not mix up the term taxes with a penalty.
Yeah.
What you have an exemption to many times is the 10% penalty when we talk about a tax deferred account. And you can read about these under IRS publication 72T if you really want to be nerdy about it.
Yeah. I've actually heard of that alphanumeric, guideline.
Yeah. So there is so many exemptions out there, guys, and you don't even realize it, from disaster relief to medical expenses, that have increased to, it could be a first-time home buyers as well, to up to a certain dollar figure, to even paying for college or paying for higher education, such as a trade school.
Okay.
So there's a lot of things out there that you can take a distribution from to avoid the penalty.
Okay.
But it doesn't mean you avoid the taxes.
Got it.
Understand the reason you put the money in there is you took a tax deduction at some point, or it was taken out of your paycheck before you paid any taxes on that money. This is why when you take the distribution, you still owe a form of taxation. Does that make sense so far?
Yep. So far, yes.
Awesome. So this also brings to the next aspect, though, is can I ever pull money out of that same account and put it back in and owe zero taxes, zero penalties? Absolutely.
Okay.
And they call it a 60-day rollover. Now, there's some debate on this 60-day rollover because it's not necessarily clear when we read the IRS tax code, and you can read it under IRS publication 590-B, right, which all deals with removing money from a retirement account.
Okay.
Now, when we do this 60-day rollover, they say you have 60 days from the time of constructive receipt. What does that mean? Typically, when I get the check and I actually deposit it in my account.
Okay.
So hypothetically, if I got the check today, but I waited 2 days to deposit it, well, then my 60 days should not start until that check was deposited.
Okay.
All right. Now, the problem with this is most custodians are still going to withhold 20% in taxation.
Okay.
So let's just say, we're going to put some numbers out. I pull out $100,000 as a distribution.
Okay.
And I know, hey, I deposit it. I have 60 days, and I put that in quotation marks. We'll talk about why in just a minute, before I have to put that money back in. Well, your company, Fidelity, Charles Schwab, they're probably only going to give you $80,000.
Okay.
Because they withheld 20.
Mm-hmm.
Well, if you try to put that money back in, believe it or not, you actually have to put in not 80, you have to put in 100. And at
even though they withheld 20,
the IRS is supposed to cut you back a check for $20,000.
Interesting.
Yeah.
Okay.
Now, what's nice, as I say this, is some custodians will actually give you the option not to withhold any funds.
Yeah.
Now, most of them won't. I always say public custodians won't. Fidelity, Charles Schwab, Vanguard. I keep bounce back. Those are the ones people are familiar with. They are always going to withhold taxes.
Okay.
Most self-directed custodians, Quest, Equity Trust, Advanta IRA, doesn't matter, choose one. Most of them will give you the option because they understand what you're going through and they're just at a higher level.
Okay.
So this is one thing a lot of people will see. They set up a self-directed account just to move in cash so they can take a distribution and have zero taxes withheld with full intent of putting it back in.
Okay. All right. And then I know you said with the constructive, receipts, and let's just say it's the 60 days. And I've always been kind of curious of this because, backstory with mine, I actually utilized this. It was a really wonky finagling I had at one point that I was selling one real estate asset, buying another one. The timing of it got flipped. Then I had this car loan. It's like, well, I'm paying that off with the proceeds of the sale, but that's going to be after we close on this one. And it was like right on the line of this DTI. And then on top of that was a bank I'm never going to use for business again. They didn't add back in depreciation on the business side. So like whatever you showed as the loss to the IRS, they didn't add back in depreciation. They just said, oh yeah, your business is, losing money hand over fist. So this kind of makes a little wonky. So, I took out the money for 60 days, paid off my car loan. And since that wasn't used for the down payment of the property, where it has to be 60 days source and season, then the bank was happy, then everything moved through, sold the other real estate, then I think I was at like day 57 or something like that. I wanted to make sure I beat the clock and went through. And then they said, all the taxes and whatnot was wiped out. 2 questions. One, I know in the real estate world, where, typically for Fannie, Freddie, Mae, if you're buying a house or buying an investment property, you have to have the down payment funds source and season for 60 days. Mm-hmm. Was that maybe put in place for some of the, money games that, I'll take money out of my IRA and then do this funky cash out refi and then put the money back? I don't know. What's your thoughts on that?
So it definitely wasn't.
Okay.
Right? The 60-day rollover, and I kind of make a joke about it, it's almost fake.
Okay.
All right. One thing we have to understand is how do we as a custodian, how does every custodian out there report that you took money out of your retirement account?
Okay.
We report it on a 1099.
Yep.
Now, if you put money back in, how do we report that? We report it on what's called a 5498.
Okay.
Now, if you've ever received a 1099 or a 5498, are they day specific?
Not that I've seen.
Are they month specific?
Not that I know of.
They're only year specific.
Okay.
So how does the IRS know you went over your 60 days or under your 60 days?
Audit.
There you go. Right now, right now, the IRS is drastically behind. So I'm not saying purposely go through over your 60 days, okay? But you need to understand that the way it's reported from a custodian standpoint is always going to be via those 2 tax forms.
Okay.
All right. So a lot of times people might go over, might go under, right? And there's truly no way for them to specifically track. Once again, this also comes back to that constructive receipt.
Mm-hmm.
Even as a custodian, I might have cut you a check today, John, but you didn't deposit it. I don't know when, right?
Yeah. Or it got lost in the mail. That never happens.
There you go. And that's actually why the 60-day was created, was switching money from bank to bank or custodian to custodian can sometimes be very much a pain. And that was the real reason that 60-day aspect was created.
Oh, interesting.
As I'm saying this, though, there is something you do want to be very mindful of. You can't pull out, let's say, $100,000 from your retirement account, put it in Apple stock real fast, let it jump up and down, then put the $100,000 back and keep your profit.
Okay.
Believe it or not, the IRS has a term for this called net income attributable tax. A lot of nasty words. But really what it says is if you did something like that, it's going to be treated as your retirement account did the investment.
Okay.
And you've got to put all those gains in there as well. If you don't, those gains will be treated as if you took a distribution from the retirement account and be fully taxed and penalized at that point in time. So you can't use it to try to cheat the system. Unfortunately, the IRS, they're a lot smarter than that.
Okay. What was that called? The net attributable income?
Net income attributable tax.
Income attributable tax. Okay.
Yep.
Just what I need is another tax to worry about.
So imagine being me and being a nerd and reading this stuff. Oh my God.
This show is brought to you today by Lightbulb Podcasting. Are you a busy professional that needs to get more time back in their schedule? If you are a podcaster like me, you have enough on your plate. Why not outsource your podcast production? From editing, show notes, keywords, scheduling, volume balancing, and editing, and creating audiograms, podcast production is another job in and of itself. That's why I use Lightbulb Podcasting. Get phenomenal support and an affordable price while you concentrate on growing your brand. Go to www.lightbulbpodcasting.com today to schedule an introductory call. Put your content in the spotlight. Now, you had mentioned with the, before with the tax code provisions, and we, kind of highlight this on a little bit. I've heard a little bit about this. I actually had a coworker at a previous job. He did this. I can't remember if it was an IRA or Roth IRA, but he did a 72T distribution where, typically with IRAs, you got to wait till you're 59 and a half. Otherwise, you pay the taxes plus the 10% penalty, like you said. Or when the 72T is put in, is this more like early withdrawal that you pay taxes, but you don't pay penalties? Or how exactly does that work? And can anyone do this?
Absolutely, anyone can. And remember, we always, and people, they naturally will combine these two terms, the taxes on the retirement account and the penalties on the retirement account. The penalty is always going to be 10%.
Okay.
72T, that actual public revenue code, that revenue code literally talks about waiving that penalty.
Okay.
Right? That's it. Now, if we have a Roth IRA, notice when we were talking about this example earlier, we were only talking about the tax deferred accounts, the traditional, the SEPs, the 401ks. But let's focus for a minute just on the Roth.
Okay.
Well, when I make a contribution to a Roth, that's after tax money.
Yeah.
So that will always come out tax-free and penalty-free.
Okay.
People don't realize this, but when you put money in a Roth, think of it almost like a savings account.
Mm-hmm.
I can remove that money any point in time, tax-free, penalty-free, no questions asked.
Okay.
Next, though, they have a special part, and it's called a conversion. If I moved money from my tax-deferred bucket over to my Roth bucket, this is a conversion.
Yeah.
Your conversion will always come out tax-free, but not necessarily penalty-free. Okay. Why does it come out tax-free? Well, you paid the taxes when you did the conversion.
Okay.
Right? Now, this is also, if you ever want to look this up, it's under, once again, IRS publication 590-B under what they label as ordering rules. Your Roth IRA has its own ordering rules and how money will be coming out every time you do a distribution. Okay. They say contributions first, conversions second.
Okay.
So now I know, all right, let's just say I had $10,000 in there as a contribution.
Okay.
And I did another $10,000 as a conversion. Well, if I remove that full $20,000, all $20,000 comes out tax-free.
Okay.
But only $10,000 of it will be subjected to penalty, that 10%, unless I have an exemption under that 72T rule.
Okay.
I might be able to pull out $20,000 and only owe $1,000 in taxes. That's not bad.
Yeah, better than your highest marginal tax rate plus 10% penalty.
There we go. So a lot of times you really just kind of have to dig into it. Now, there's one extra layer to those ordering rules called your earnings.
Yep.
Now, in a Roth IRA, obviously I have my contributions, we mentioned, money I've put in there. My conversions, money I've moved from a tax-deferred bucket, well, that money should be earning profit. Anytime you pull out your earnings, they're always subjected to taxes and penalties in the Roth, unless you meet, your 59 and a half, that 5-year rule, or one of those exemptions under 72T.
Okay.
So notice, before we ever move money from a Roth account, you really want to look into this and have a CPA that understands the ordering rules, or just call myself or anyone at Quest. We teach classes strictly on this area of the tax code so often that without looking at anything, I know it's on page 35 of 590. Like, that's how often we do it. So you might actually be able to pull out more money from your Roth IRA, penalty-free, tax-free than you ever realized, no matter what your age is. I'm a prime example. I found a house I wanted to purchase as a homestead. I actually was able to remove $14,000 from my Roth IRA to use as a down payment. Okay. That's pretty impressive.
And no taxes, no penalties.
No
just
taxes,
right to the...
no penalties.
All right. Interesting. Can you speak, and I know we've talked in the past too, I mean, obviously I invest in real estate, but I'm also a realtor that works with a lot of first-time home buyers. Mm-hmm. Obviously, we're not going to go down the laundry list of every single exemption known to man. Yeah. But for, say there's a couple that's, I don't know, been married for a number of years. They have I don't know what's one better, a 401k or an IRA, but regardless, they find a house they like, for whatever reason, they don't qualify for some, or maybe the property doesn't qualify for an FHA loan, for instance. What are some ways that, a down payment for their first home, primary home, retirement accounts could be utilized for that?
So I always try to break up the tax deferred accounts and the Roth because they are different.
Okay.
When we both types of retirement accounts have a first time home buyers clause that says you can move up to $10,000 in earnings completely penalty free and potentially tax free if it's the Roth.
Okay.
All right. Now, if we think about this, if I have $20,000 in a traditional IRA, that's that tax deferred account.
Yeah.
Well, I know I can pull out $10,000 completely penalty free, but remember that $10,000 is always taxable.
Sure.
It's added to me as income. So I avoid the penalty, but man, I'm still going to owe taxes on this. And that's going to raise some red flags typically with any lender because they won't be able to necessarily count that as true income.
Right.
Change the example though. I have $20,000 in my Roth IRA.
Okay.
Well, I know I can remove $10,000 tax-free in earnings.
Okay.
Well, what if the other $10,000 is contributions? Remember, I can treat my contributions in a Roth IRA almost like a savings account.
Mm-hmm.
Now the bank can actually justify you removing that full $20,000, 100% tax-free, penalty-free, and use that towards your down payment. Remember, $10,000 is contributions,
Sure.
$10,000 is earnings. Well, that's nice to know. And that's exactly what I did. That's how I used my Roth IRA to help purchase my very first home.
Okay. Interesting. So
now they also define a first-time home buyers as your first home within the last 2 years. This is important to understand as well, because I, as an individual, before I was married, I actually purchased my first home using my first-time home buyers.
Okay.
But guess what? When we went to buy our second home, right, me and my wife, we actually kept that home. We moved out of it, kept it as a rental.
Okay.
We went to buy a new home. Guess who used their first-time home buyers to buy our new home? Worked out well.
Yeah. Okay. So it's a first-time homeowner, second-time house. I don't know how you want to word that.
Right. So, and the rules in this area are also a little vague. So always want to make sure you double check with the CPA.
Okay.
Before you take this distribution to figure out, all right, what amount is contributions? Which amount are earnings? Which amount is conversions?
Okay.
And if you do have questions on this, once again, you can always ask, trained professionals like myself or anyone at our company.
Okay. So, this just kind of popped in my head, and I'm thinking, because I've had, retirement accounts since I'm 19, and, company A buys company B, this roller goes to this rollover, and, so on and so forth. Is there any, how I put this, say, you're with company A, you have, traditional 401k and a, Roth 401k. And during that time, you did $10,000 of contributions and then $10,000 of conversions. So we're at the 20,000, but then, you move companies, you go to a Roth IRA, whatever the case may be, then that $20,000 total, contributions, conversions goes to a new retirement account, whatever that is. Is there any record keeping from all those custodians, or as far as it goes, the last custodian, as far as they know, that $20,000 is just a rollover in their minds?
So and I've seen cases where this doesn't happen. All right.
Okay.
But a proper custodian, all right, and this usually happens with larger companies.
Okay.
Right? We'll do good bookkeeping in this area, when you're, but they call it a basis. Your 401k, if I had a 401k at company A and I moved to company B, when I move it over, I have a basis contribution. This means that this money came from a separate employer, a separate account, a separate something, and it has its own tracking purposes for that reason. Okay. And that's why they call it a basis. Hey, this is the basis that came and moved over. Okay. Unfortunately, notice I said a good company does good bookkeeping on it. I have heard, and I won't mention any names, but there are some companies out there that unfortunately they just don't care. Yeah. And that's really what it comes down to. I can let you know some of the companies that do some of the really good bookkeeping in this are the like a Fidelity.
Yeah.
to be honest. And I don't work for Fidelity. I can't I'm not promoting them or saying, hey, go with them or something like that. But I'm letting you know, like in these cases, anytime we run into this with a client at Quest, Fidelity has fantastic books, and it takes them 72 hours to transfer it, move it anywhere they need to. And they're like, yep, here you go.
Yeah.
Thanks. I wish it was that way everywhere.
Exactly. Yeah. And I won't name names either too. I remember years ago at a previous employer, I think it was just a local bank or something that was a custodian. They didn't keep records worth of crap, because you had mentioned with the Fidelity, because I had ran into this with rollover, I think, to my self-directed account. And Fidelity even says like, well, this is all we have. And like, well, should there be some kind of breakouts? Like, no, we never got anything from the previous custodian. So, the old adage, garbage in, garbage out, I guess kind of plays in or runs in there. So
now, if you're an individual and you want to learn how to track this yourself, all you got to do is save 2 tax forms.
Okay.
One is the 5498, which your custodian should give you. And if you use a CPA, some of us don't use a CPA, especially if you have just a W-2, you hop on TurboTax.
Sure. Yep.
But you want to look for the form 8606.
8606.
Right. This form is pretty much every time you make a contribution to a retirement account should be filled out. And both these forms then should match. And that's what you've contributed, whether it was tax deferred, post-tax, pre-tax, whatever you want to call it.
Oh, okay. Interesting. So, all right. So then kind of leads me to, like I said, I'm all about, tax strategy, trying to figure out a way to, minimize taxes, minimize penalties. I think Uncle Sam gets enough money of ours as it is. If there's, I'm just going to throw out some, variables. Let's just say I have $50,000 in my traditional IRA, and I say, I need to take that money out. It's not for, medical exemption. It's not for first-time home buyer or hardship, disaster, whatever. It's like, I want to go to Vegas and just try my luck on the roulette wheel. I don't know. But as I understand, if I take out that $50,000, that $50,000 is counted as income, taxed at my highest marginal rate, plus the 10% penalty, like you said before. Is that correct?
That's correct. In that example, that's perfect.
Okay, sounds good. So then if, I'm just kind of playing with numbers, like we've always talked about conversions, some people I think jump the gun on conversions and they don't think about the tax hit as well, especially if it bumps them in another tax bracket. If like, say, I have $50,000 in my tax deferred IRA bucket, as luck happens, year after year, I always tend to get a $5,000 rebate from the government. And I start to think to myself, it's like, well, if I chunk this and do a $5,000 conversion every year, so $5,000 rebate, $5,000 quote income, net zero, it's kind of a wash, if you will. Do that for 10 years. Now I have that $50,000 sitting in my Roth IRA. If I were to take that out, since it was a conversion, is that then just a 10% penalty at that point, or?
Perfect. Yep.
Okay.
And that's that ordering rule. Remember, so we always break down the contributions and the conversions.
Gotcha. Okay. So, and then hypothetically, let's just say I'm the, I don't know, the next Peter Thiel, I pick the next Facebook or Luna stock or Luna crypto before it implodes, or whatever the case may be. If I have $50,000 rolled into my Roth IRA, that 50,000 then grows to 450,000. So there's $400,000 of earnings. And then for whatever reason, okay, I just want to take out the entire 450,000. Then you're kind of looking at a mismatch of what I get for a penalized and then what I pay taxes on the penalty. Is that correct? Or?
Excellent. So in that example, right, the 400,000 would be taxed and penalized. Okay. 50,000 would only be penalized. And this is where you really got to separate the taxes and the penalties.
Sure. And that comes into the contributions, conversions, then earnings or growth, if you will. So, okay. Sounds good. And then you had mentioned this before, and I've heard this both ways, and maybe you can put a clamp on this, because I've heard like, oh, if you put money into a Roth IRA, you can take it out anytime tax-free. But then I've also heard like, well, you can, but then either that Roth IRA has to be in existence for at least 5 years, or that contribution, that conversion, whatever the case may be, has to be in there for 5 years. So if I do, round numbers again, I do a $5,000 contribution here in 2022, I can't take that out without being penalized until it would be July 2027. Is that correct? Or is that different?
So a lot of people get really confused with this 5-year rule that a Roth IRA has.
Okay.
All right. And the purpose of it is if you're over 59 and a half,
okay,
you can't just set up a Roth IRA today, do a conversion and say, hey, great, all my money's tax-free now moving forward.
Okay.
All right. The real purpose behind the 5-year clock is when we're older, all right, to say, hey, look, you can't just do a full conversion and walk away scot-free.
Okay.
But we always got to get back to that ordering rule aspect. Remember, contributions, period, point blank. When you contribute money, can come out ignoring the 5-year rule,
okay,
tax-free, penalty-free, 100%.
Okay.
All right. The 5-year rule, though, does apply to the conversions.
Okay.
All right, and will apply to the earnings. This is why it's really good to set up a Roth IRA today at any custodian. Whether you think you're going to use it or not, put $10 in it. All right. The reason why is that 5-year clock isn't from the custodian, it's from the IRS.
Okay.
So if I have this Roth IRA, I've had it for 10 years, and I close it down, and next year I open up a Roth at a different company, well, that 5-year clock comes with it.
Okay.
So it doesn't just disappear. It doesn't start over.
Okay.
All right. So a lot of times that's a misconception. But what's nice to know is that the contributions themselves will always come out tax-free and penalty-free.
Okay.
Now, once we're 59 and a half, the IRS says you have to meet 2 requirements for anything to be tax-free. One of them is that 5-year rule, right, that needs to be satisfied.
Gotcha. Okay. So that's a kind of a, trying to think of a good analogy, and I'm kind of explaining. Well, even kind of like, was it the carry? Yeah, if you can't use the depreciation on a property and tax year 2022, it kind of carries over to 2023. So
Perfect.
The 5-year clock kind of just carries along, whether it goes from Fidelity to Vanguard to Quest to whomever.
Exactly. And that's how I always describe it, as it comes from the IRS, not the banking institution.
Gotcha.
If you think of it from that standpoint, you're like, obviously that makes sense,
Okay. So then the IRS would show that Derreck Long opened up a Roth IRA in 2017. So, okay, the 5-year clock had passed, even though he only threw $10 in it, December of 2017.
Yep, because they're not actually looking at the dollar figure. They're looking back at that tax form we mentioned earlier, the 5498 or the 5498, right?
Okay.
That shows that I set up a Roth and I put money in it.
Okay.
That starts my clock.
Gotcha. So, yeah, I have to keep track of all these forms. Normally, I put links for everything mentioned in the show, but I'm thinking if I list all these alphanumeric forms, that people are going to fall asleep when they read the show notes to this later.
What's funny is I wonder if people think that I am like reading something, but like for those of you out there listening, I really do have all this memorized.
Wow.
It's funny to memorize all this stuff.
So, all right, let's see. So, yeah, this just kind of, thinks of different tax ways to do this. So, if as we're talking, I think we're officially in a bear market in the stock market. I'm not exactly sure where we're at this, point, but let's just say, well, I'll just name it. Asset A is in my traditional IRA, and I bought it for $1,000, and it was, Netflix stock or GameStop or whatever the case may be. But regardless, it went from $1,000 down to $100. At that point, then I say, okay, this has taken a beating, but I think whatever the asset's going to rebound. Then if I do a conversion, then the conversion is set to I'm taxed on the $100 value when I converted it, not the $1,000 value when I purchased it. Is that correct? Or?
That's correct. And this is a very common tactic to even use in real estate.
Yeah.
Prime example is anyone out there who's ever invested into a syndication.
Yeah.
All your syndications go on what I like to label as a J curve. I invest $100,000 in year 1. Year 2, that 100,000 is really only worth about 80 or 90. Year 3, it's usually at the bottom. Let's call it 70,000. But year 4 and 5 is when the earnings hum and then your money doubles.
Yep.
Well, I can actually do a Roth conversion of that asset.
Okay.
In year 2 or 3, and we see a lot of people do this. We even teach a class on it, on converting at the right time of the J curve.
Okay. So then you kind of maximize the uptrend in the tax-free bucket, so to speak. So,
and this is common with anything from cryptocurrency to stock to all sorts of stuff. Sometimes when we see something peak up, we'll see people put a lot of money into it, hoping that it's going to come down so they can do the conversion and before it goes back up.
Sure. So, okay. Would there be any, I don't know if off the top of your head, I mean, obviously, if it's Netflix stock, I just pull up my whatever Fidelity app and okay, it's trading at whatever, $68 today. I move it over. Okay. The cost base is $68. I know you mentioned real estate, you mentioned syndications, crypto, stocks. Can this work for any asset held in a retirement account, or would there be any exceptions of no, Derek, you have to sell this into cash, convert the cash over, and then repurchase it in your Roth IRA?
No, so it can be done with any asset. The problem is valuating the asset.
Yep. Okay.
All right. So when we think of how to value Netflix stock, well, it's currently worth blank.
Yeah.
That's the value.
Pretty cut and dry.
Let's pretend I bought a home. I'm doing a fix and flip.
Okay.
How do I value that? I got to get an appraisal. That's going to cost me some money. I might not want to spend the $500 to get the brand new appraisal to do a Roth conversion.
Okay.
So there is a little difference, on the types of asset and how they're going to be appraised for Roth conversion purposes.
Okay. All right. So you can do it. It's just more subjective when it's not something I can just pull up on the internet and, stock, crypto, oil futures, whatever the case may be, where it's pretty cut and dry.
I actually have one client that purposely, he buys a house as a fix and flipper.
Okay.
Right? He waits till halfway through the rehab, and then he brings in an appraiser because the appraiser is always going to appraise it less than what he purchased it for. And it's well worth it to him, And so I see that actually done. You're going to think a joke about pretty frequently.
Wow. And I could just see the appraiser just getting the work order like, oh, that SOB again is doing this.
Right. But and you got to think, if you're buying a house and then you wait till midway through the rehab, the house is destroyed.
Right.
Everything's torn. Oh, there is no cabinets. Oh, there is no countertop.
Exactly.
And so they appraise it way lower.
Oh, interesting. Boy, I'm learning all sorts of tactics I might have to use as well. So.
Yeah.
But kind of brings into my final question, Derek. And you kind of touched on this, syndications, which I've touched a little bit on my podcast, actually having a few guests later on the show to talk about, 506C, 506B, all that fun, more IRS language, so to speak. But, typically with any, syndication or, generic term, I'm just going to say crowdfunding, where a bunch of investors pool their money together, buys let's just say an apartment complex per se. And typically they'll always get a K1 where it shows, well, Derek invested 10,000, John invested 10,000. Here are the earnings, but there's this breakdown depreciation of your portion of the apartment, the cabinets, all the stuff in it. Now the K1s, I wish they came out in January of every year, but I know they're a little convoluted to put together. Yeah. In a, outside of a retirement account, the K1s can be handy because they can lower my taxable income that I pay the IRS. Sure. If that asset is in a, retirement account that's already tax advantaged, is there any benefit to the K1 at that point, or is it pretty much just stick it in the shredder? Okay.
No. So this is a common thing, and you'll hear this term, and it's the wrong term, but then I'm going to fix it in just a minute.
Okay.
Most of the time, when an IRA invests into any syndication, I don't care if you're talking storage unit, multifamily, senior living, you name it, right? Okay. That deal is considered to be debt leveraged.
Yep.
Now, because it's debt leveraged, the IRA should pay, and the syndicator gets this wrong every time, but they call it a UBIT tax.
Yep.
It's actually labeled a UDFI tax, unrelated debt finance income tax.
Yeah.
Now, the reason this is important to distinguish is the UDFI allows the IRA to claim the same depreciation you typically would.
Okay.
That loss you see up there on that K1, the IRA can take that loss and put it against the UDFI tax that it owes at the end of the syndication.
Okay.
Therefore, making it truly tax-free in most cases.
Okay, interesting.
So even though you might not be claiming the tax, the depreciation, and the deduction yourself personally, understand the IRA is. So you don't ever just want to get rid of those K1s, and you want to make sure you have a CPA that understands the difference. Okay. The biggest problem I see people run into is they look up, oh, well, your syndicator said you owe a UBIT tax. UBIT literally stands for unrelated business income tax. Mm-hmm. It's when my IRA is running a business.
Okay.
That's not what your IRA is doing. You invested into a syndication.
Exactly.
The problem is people, they just throw out random terminology and they get it mixed up. So make sure if you guys are out there and you're doing a syndication, you have a CPA that understands UDFI, not UBIT. They're drastically different.
Well, maybe it's just because UBIT kind of rolls off the tongue a little bit easier than UDFI, you know.
Absolutely, it does.
UDFI? I don't know if that makes any sense.
You know what's even more messed up is UBIT's not a thing. It's actually called UBTI, Unrelated Business Taxable Income.
Oh, but they
you look it up in the tax code. Real estate investors started calling it UBIT.
Oh, geez. Yeah, UBT doesn't really ring as UBIT, exactly. I guess. So, all right. All right.
I'm a nerd.
Yeah, no, this is definitely educational, and I nerd out on this stuff all the time too. So, as we're getting to the close of this, Derek, and I know you and I have talked back and forth of the tax laws are always changing, and there's 37,000 bills in various subcommittees to make changes to retirement accounts. Anything maybe new or that you see coming down the pipeline that my listeners might find interesting or might be beneficial?
So the one thing you guys want to look out for, and I taught a class on this just a few weeks ago, and I'm also spoke in front of Congress on 6 different occasions about these type of things. All right. But it's labeled as the Secure Act 2.0.
Okay.
Now, this is very important. Make sure you don't look up the wrong Secure Act, because the first Secure Act everyone hated, and everyone tried to boycott it. It didn't matter what industry you're in. Or anything. All right. But Secure Act 2.0 has a lot of different sections in there. Right.
Okay.
Now, what's unique about that is each section, which ranges from section 101 to section 322, really involves in different areas, but a lot of it happens to be very positive for all of you guys out there. From things of student loan payments, like you can pay a student loan payment and your employer has to count that as if you made a contribution to your retirement account and match it.
Okay.
That's pretty cool.
Interesting.
Up to decreasing prohibited transaction rules, to allowing SEPs, simples, any other type of retirement plan like that to have Roth accounts that they didn't have Roths before. Even increasing Roth catch-up contributions. Now, I could talk all day long about it, but Secure Act 2.0 is one of those things that you kind of maybe want to look at.
Okay.
Just from that standpoint.
Okay, interesting. So, and then you said the catch-up contributions. I think that's was it about $1,000 more that you can put in if you're 50 or older, is it? Or
that's correct. So it is if you're 50 or older.
Okay.
You right now get $1,000 catch up. However, if the Secure Act 2.0 passes, which most likely it will, it passed the House of Representatives of a 96 approval rating.
Wow.
Right? Meaning both Republicans, Democrats, didn't matter. They all said yes to it. That never happens.
Yeah, exactly.
Now, right around November, we'll have the next election period for our senators and our House of Reps. Mm-hmm. So during that period, we'll see this vote, the bill on this, actually be voted on again and passed, most likely. Yeah, that's pretty much it. It's most likely going to pass, and it's going to have a lot of positive influence in that area.
Okay, sounds good. All right. Well, this is all, very good info, Derek. I hope my listeners, if their brains haven't blown up at this point, at least they maybe got a golden nugget or two, maybe to think about with their retirement accounts. If anyone, was interested in, learning more, opening a Roth IRA to, throw $10 in to start the, 5-year clock, or, do a rollover, a conversion, or anything like that, what'd be the best way to reach out to you and or Quest?
So we use a non-automated line. You can call us Monday through Friday, but it's 855-FUN-IRAs, right? But that is a non-automated line. I think we're the last company in the world to do that.
Wow.
But to be honest, no matter what, if you're out there, set up a Roth IRA. It doesn't need to be a Quest. If it is with me, great. I'll help you and I'll answer any questions you have. But everyone out there should have one. This is the most powerful investment tool the IRS has ever given us. And any banking institution, any custodian can set one up. Most of them will do it for free.
Okay. That actually brings one question up, because I have been thinking about this for my son who just turned 10 months now. I know in order to contribute to a Roth IRA, or any IRA for that matter, you have to have earned income. So if all my income's from a rental property, that's considered passive income, not earned. However, go ahead.
So your CPA naturally probably labels it as passive income because that's going to be the cheapest tax rate for you.
Okay.
But if you said, hey, can you take some of my passive income and make it active income so I can pay myself or pay my kid?
Okay.
The IRS says, yes, please, you're going to pay more taxes.
We get more money. Yeah. Okay.
Of course. So most of the time we don't ever think of that as a solution, but you can relabel your passive income if you like.
Okay. And then just have to weigh in the trade-offs of, well, a higher tax rate, but then I can contribute to a Roth, which grows tax-free for 40 years. I mean, everyone, you'd have to run the numbers. Most of the time you're talking $500, maybe right. So,
you're not talking about anything that's going to drastically change anything,
Okay.
And so you got to think, all right, well, I'll pay my kid his $500 a year so I can put it in his Roth and, let them start learning how to even do minor investments or how to save it.
Okay. So the Roth IRA can be opened at any time. And it's just a matter when you have earned income, however you move it classified.
They're getting mowed lawn.
Yep. That's when you can make contributions. Okay. All right. Note to self. We'll open a Roth IRA, Ronnie's Roth IRA before too long.
Bam.
So, all right. Well, thanks again, Derek. I appreciate you coming back on the show. And for all you listening, be sure to hit that subscribe button and reach out to 855 Fun IRAs to actually talk to a real life person and then see what Quest IRA can do for you.
Thanks, John, for having me. Appreciate it.
Thanks again. Appreciate it.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.